And today we're going to talk about 5 reasons not to use whole life insurance. Let's get started. Okay. Let's see how to do this thing. All right, let's do a screen share.
Whole life insurance is a good product for you to buy and or keep. And here are 5 benefits to help you make that decision.
Benefit number 1 is control. When you have a whole life insurance product, you are signing a contract between yourself and the insurance company, which means that this is a private contract between you and the insurance company, which is a huge benefit for you because that means you are in complete control. Unlike a lot of financial products that are out there, if you do sign a contract between yourself and another financial institution, you don't necessarily have control as far as what happens with your account and how you can best manage it. So with a whole life insurance product, you have complete control over the policy and you can access it to your desire without penalties or issues as far as however you want to use it.
That's BS. You do have control over your finances in banking institutions or brokerage accounts. You can move your money how you want to move your money. With whole life, you don't have control. You don't even know what products they're investing in. When they say investments, you don't control any of the investments in your whole life. So that's bogus right there, but continue.
A mentor that tells us all the time is that you don't lose money until you lose control of it. So the nice thing about this whole life insurance contract is that you maintain control throughout your entire life.
Yeah, so you don't lose control of your money.
You don't even need life insurance for your entire life. You need it for about 20 years, 25 at the most, because your finances should be in order at that point to where you have a living will and you have enough in your retirement account. If something happened to you, everything should be taken care of in that time. Let's keep going with these weirdos.
There you go. Benefit number 2, cash value.
Oh.
Every single time that you make your premium payment, cash value accumulates inside your policy. Now, the nice thing about having this cash value accumulate inside your policy is the fact that you earn a guaranteed 4% interest on this money. Now, there's 2 ways for you to access this cash value that's earned.
So the cash value he's referring to is your own money. And he's talking about a guaranteed 4% interest. They guarantee 1 to 2% interest and a non-guaranteed 4 to 6% interest. And the reason why the interest is so low that you're guaranteed is because they're giving you half of the interest that it actually makes. So if you had your own investment account, instead of putting it into this garbage whole life insurance policy and you put it into good mutual funds, good ETFs that's generating 8 to 10% interest, the whole 8 to 10% interest is yours. And you have control and freedom that they say you didn't have to move it around and make good investment choices. This whole life, what happens is if the life insurance policy take your money, make 8% of your money, they give you 50% of the interest rate. That's why he's saying 4%. So if they use your money and make 8%, they give you 4%. If they use your money and make 12%, they give you 6%. It's trash. Let's see what else he say about this great cash value garbage.
Earning this 4% interest. That's through a withdrawal or through a loan. Now here's the cherry on top.
First of all, let's stop before you say cherry on top. He said through a withdrawal or through a loan. It's your money that you're putting into it. How the hell can somebody loan you your own money? And guess what happens with loans? You pay interest on loans. So you're going to put your money in and they're going to loan you your own money and make you pay money on your own money. Stupid at best.
If you access this cash value through a loan, you do not disturb the compounding inside this policy, which is amazing because this allows you to kind of be in 2 places at once.
And why would you need a loan on your insurance policy to begin with? This is why you need to have an emergency fund. All right, so let's clear something up. When he say a loan, so let's say if you had a $500,000 whole life insurance policy, it's not a loan on the 500,000. It's the loan on what you paid in. So let's say you paid $6,000 into it so far. You get a loan on 90% of that, so you can get a loan up to 5,600, right? Or 5,400 rather. It's 9% of um of 6,000, and then you paying an interest rate on it when you pay it back. Compared to what? Let's compare that to, instead you put your $6,000 into this whole life insurance policy, you put your $6,000 into your emergency fund, and you needed the 5,400 out of there. You can just go get it. There's no loan associated with it. And then you can have a term life insurance policy. You're only paying $50 a month. But this policy, you're paying probably $700-800 a month on. It's throwing away money, and you losing a whole bunch of money. Let's go.
Depending on how you use these funds. Now, we talk about cash value and throughout a variety of different videos that we post here on YouTube. And you know, we love using the infinite banking concept in order to pay off debt, in order to invest in.
Infinite banking is garbage. And also, you don't need infinite banking to pay off your debt. You need a budget and pay off your debt. You can use the Dave Ramsey snowball effect to pay your debt off, where you take the lowest amount you owe, write it down to the highest amount you owe. You pay on the lowest by making minimum payments on the higher ones. And then from there, you add whatever you're paying on the lowest to the next one. And you keep doing that, the snowball effect. Or another option, which, you know, I wouldn't encourage. I encourage the Dave Ramsey one better, but because you know the credit cards and all this debt be high interest rate. But you could go to the bank and consolidate all these loans and pay one interest rate of 10% or whatever and pay it off that way. But you can use the Dave Ramsey effect. This whole life. See, this is the trash about whole life insurance policy. They trying to make it a life insurance policy at the same time trying to make it a lender, at the same time trying to make it an investment account. If you want an investment account, go to Fidelity Bank, right? If you want a way to save money for emergencies, go ahead and make a money market account and put away 3 to 6 months of money. Let's continue.
Make investments or to provide a legacy to our family or pay off some loans, things of that nature. Now, you know the power of being able to be in two places at once, because you're able to do all these things and not disturb the compounding when you take a loan. Again, you do have access to it through a withdrawal, but through a withdrawal, you reduce the cash value inside your policy because you have it in hand. Those loans, you're collateralizing the cash value. You're getting a loan from the insurance company, which leaves your money undisturbed, earning a guaranteed compound interest rate.
And a really good thing to note is that not only is your policy growing at the guaranteed 4% compounded interest rate, where else can you get that?
Yes.
Because right now in your savings accounts or even money market accounts, you don't have that high of an interest rate being paid.
See what they're doing? They comparing an investment to a regular bank account. That's not fair. That's apples and oranges. They need to compare that 4% to a Fidelity brokerage account. That's what they need to compare it to. They need to compare it to growth stock mutual funds. That's what they need to compare it to. They need to compare it to Vanguard ETFs. That's what they need to compare this whole life investment garbage to, not compare it to a little regular bank. A regular bank isn't designed to grow your money. Investments accounts are designed to grow your money. So that's what they need to compare it to. They're not comparing it to the proper thing, right? That's like me comparing the athleticism of a volleyball player to a defensive lineman. It's two different things.
Out to you. And again, we're just comparing it to the banking functions. We're not talking about any of the investments that you're making. We're just simply comparing it to a bank. So comment below if you currently have a whole life insurance policy and maybe not know some of these benefits that we're talking about. So benefit number 3 is dividends. This is the non-guaranteed portion of your contract premium, which
Lord.
is the dividends that are paid to you. Now, as long as you work with a mutual insurance company, you could possibly be paid a dividend each year. Now, what a dividend is at the end of the year when the insurance company is profitable and they've paid all of their expenses, whatever is left is returned back to the policy owners in the form of a dividend. So we call that a return of premium.
So the money being returned is what you overpaid into the policy. They're returning you your money that was overpaid. By law from the IRS, they have to return you that money. Now, if you want dividends, like I said before, it's mutual funds and ETFs that give dividends every quarter. Okay, look, this is silly at best, and these guys, they look silly, to be honest with you. Yeah, so let's continue on. This is annoying, to be honest.
And due to the IRS, how this is classified, you are not taxed on these dividends. So that's another bonus.
Why would you be taxed on money you overpaid? It's not earned income. The only money you taxed on is earned income. They keep doing this, right? So what they saying stuff and putting it in the wrong category. Why would you be taxed on dividends when the dividends is money that you put in? It's your money being returned to you. That's like the government taxing income tax return, basically, as earned income. Stupid.
Point or feature of a whole life insurance policy is the fact that you are paid a dividend.
Yes, and that dividend is amazing because you don't have to do anything. Just have a policy and you are able to share in the profits of that company through the forms of a dividend. Benefit number 4 are riders. Riders are additional features and benefits that can be added to your policy for your specific needs. Let me give you a few examples of additional riders. Terminal illness rider. If you have this attached to your whole life insurance policy,
you can get that same thing through term life insurance. Like I have it on mine. Right. It's $47 without the terminal illness, right? It's $47 a month without the terminal illness. And when I add the terminal illness, it was still $47 a month. But let's continue.
And you're diagnosed with a terminal illness, a portion of your death benefit can be utilized to take care of your medical expenses. This is similar to a chronic illness rider. If this rider is attached to your policy and you are diagnosed with a chronic illness, then a portion of your death benefit can be utilized to take care of your medical expenses while you're still living.
There's so many different riders out there that you can explore. Those were just a few that Darius mentioned, but there's others that will help you determine how your death benefit is paid out to beneficiaries. And then also there's policies, one that we are very familiar with and use a lot, which is called a paid up additions rider, which allows you to add additional cash value inside your whole life insurance policy so that you have cash value available in the very first year.
Yes.
Because typically with a traditional whole life insurance policy, it takes a few years for that cash value.
And it takes a few years for the cash value to get there because guess what? It takes a few years for you to put money into it to build it up. That's why. In a few years, you putting it into a whole life. You can be putting it up for your emergency fund. In a few years, you can be putting it into good growth stock mutual funds and ETFs and growing 8 to 10% a year, 8 to 12% a year in those few years. That's real compound interest, not this trash.
To build up. So you don't necessarily see really any cash value until maybe the 3rd or 4th year of that policy. And lastly, benefit number 5 are the tax benefits that come along with this policy. So because you put in after-tax dollars into a whole life insurance policy, the cash value grows at a tax-free rate. Now, what does this mean for you? All the years that you have your whole life insurance policy, you are...
Guess what a 401k do and a regular IRA account do? It grows tax-free. It's tax-free until you pull the money out. That's why a Roth 401k or a Roth IRA is much better anyway, because is after tax dollars going in. So when you take it out, it's not taxed. And studies show that people put the same amount into a 401k as they do a Roth 401k, and the same amount into a Roth IRA as they do an IRA. So yes, this is pre-tax dollars going in, and it's growing. And when you take it out, you're going to get taxed. And if you do any kind of math, you can use calculator.net or something like that. Investment, what's it called? Asset investment or something like that. And you can see the difference between a Roth 401k and a Roth 401k and a regular 401k and a Roth IRA and a regular IRA. And you'll see that it's much better to do after tax dollars into your investment account, your retirement account. This is garbage.
We're not going to be taxed on any of that growth, nor the cash value that you utilize, as long as you request a loan.
And the nice thing about adding after tax.
Hold on, oh my God. They said you're not going to be taxed on a loan. Let me breathe. Because it's fucking annoying. Sorry for swearing. There's no loan in the world that you get taxed on. Because it's a debt. It's not earned income. You understand? When last time you got taxed on the car loan? When last time you got taxed on a mortgage loan? It's a loan. It's not earned income. It's debt. Why would you get taxed on it? That's what I'm saying. These people, anytime they start doing this, y'all need to run. They talking slick.
Tax dollars into your whole life insurance policy is the fact that you know where taxes are right now. You have no idea what taxes are going to be in the future.
So now that you know the 5 benefits of whole life insurance, do you know how to use your policy? Because you can actually use it right now today while you're living by accessing the cash value inside your policy. Because the thing that you need to know is that you can use
the cash value you got in your damn wallet right now. This is garbage. I'm done with them. Seeing stuff like that's annoying because they trying to be slick, and it's trash. It really is trash, especially if they selling a product like that. Get term life, get a 20-year policy. I paid $47 a month for 1.5 million. Right. My wife paid $11 a month for 200,000. And the other money that we have that we not throwing at a garbage policy is going to our investment accounts, where it should be going and growing 8 to 12%, not into some whole life where you're guaranteed 4%, which is a lie. Yeah, the guarantee is 1 to 2%, and the non-guaranteed is 4%. Either way, it's still half of what they're making off your own money. And so, like, dislike, comment, subscribe. Tell me why whole life is better and I'm wrong. Tell me why term life is a lesser of the two and I'm wrong. I'm open for it, but I'm not wrong.